The most profitable stock ever realized a 255 million% return. A dollar invested in Altria would be worth $2.65 million today. Turns out selling cancer sticks is quite lucrative. So is selling stone, sand, and gravel. That's what the second most profitable stock ever does, Vulcan Materials. Today we're going to look at some of the world's most profitable companies, but let's start with the concept of value creation. So, valuing a business or asset is rather tricky, and they teach you these various methods in B school. You have the asset approach, replacement cost or cost to build. You have income approach and market approach. Of course, the value it's willing to assign to any particular company. And I love this quote here by Ben Graham. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. And when you think about the intrinsic value of a particular company, perhaps the most intuitive thing to do would be to think about it as a cash-generating machine, at least in the later stages of its maturity. And you can then forecast cash flows and then discount those cash flows to present value. That's because the value of a dollar next year is less than the value of a dollar today. Now, a stock represents fractional ownership of a company, and it's very important to distinguish between stocks and companies. So the price of any given stock is largely irrelevant. So you see these articles like 10 stocks under $10. That's just total rubbish, right? So it's creating this false notion that a stock is cheaper because of its actual price. Now, trading under $1 a share can have some listing implications for companies. So that's relevant, but the price otherwise doesn't really matter. And in terms of how large the price of a stock can get, that used to be a concern for retail investors, for example, that are buying smaller amounts of shares. But since most brokers support fractional share purchases, that isn't an issue anymore. So this idea of the present value of future cash flows is rather intuitive. And since a company is a cash generation machine, typically, as I said, in later stages of maturity, questions you might ask are, how consistent are their cash flows? What does a company do with them? Does it reinvest that money into the business, or does it give back to shareholders in the form of, for example, repurchasing shares or paying dividends? For this exercise, when we look at the world's most profitable companies, we're always going to invest every dividend, and that takes advantage of the snowball effect. And here you can see the power of dividends and compounding over time for the S&P 500. What happens when you don't reinvest dividends? You have, $800,000. And when you do reinvest dividends, you have somewhere around $5 million. Now, going back to 1960, 85% of the cumulative total return of the S&P 500 can be attributed to reinvested dividends and the power of compounding. Now, today's paper is rather interesting. It's titled, "Which U.S. Stocks Generated the Highest Long-Term Returns?" It's by this gentleman here, Hendrik Bessembinder, and he published this over the summer. We've referenced it in a number of videos, and today we're going to take a look at that entire paper. Now, when he looked at calculating the best performance, he took the universe of 29,000 stocks that ever existed. That's very important. So if you go to a typical data vendor and pull a list of stocks, it's going to show you active listings. Here he has data for everything that ever existed. He made sure that you had at least a year's worth of data. We're going to talk about that. So he examined various durations. One thing to note, over half of the stocks in this universe realize negative compound returns. That speaks to our strategy here at Nanalyze, which is to use a red flag approach when we're investing. He calculated returns using a buy and hold strategy. As I said, each dividend reinvested in the same stock until it was either delisted or purchased, right? Delisted for any reason, right? It could be gone bankrupt or acquired, or until the end of 2023. Any stock that was actively trading, you would have reinvested dividends up until that point. He then ranked the stocks by cumulative performance in various buckets, and here's the big wow table, right? So this is sorted based on cumulative compound return, and as for duration, it's very important. You should say, well, how long did it take for you to achieve that return? Well, you can see the years column here. You see everything here is at least over, it seems, 70 years. The cumulative gross wealth per dollar. So that puts these large percentage numbers in perspective. So for Altria, that's the company that has the best performance over time. It's rather remarkable. I guess when you sell a product that people can't stop buying, no matter how hard they try, that they're addicted to, that can be very lucrative. So a dollar invested in this firm back in 1925, over 98 years, would have turned into $2.6 million. That's just remarkable, right? Now, when we look at this table more holistically to try to learn something about these types of companies, we note that 3 no longer trade. And when it comes to the other 27, we've broken those down here in a table on the right that shows them by industry or sector. And you can see food and tobacco there at the top, machinery, equipment and components, aerospace and defense, pharmaceutical. So it's actually quite a variety. You don't see a lot of tech firms in here. We're going to talk about why that might be. But one thing to note here, it's rather interesting. So you have Altria Group and Vulcan Materials, as I said, the top two there. They both present in the data for the full 98 years. But when you look at their cumulative returns, this is rather remarkable. So although Altria's compound annualized return of 16.3% is 1.16 times as large as Vulcan's 14.05% annualized return, Altria has a cumulative return that's close to 7 times as large as Vulcan's. So the takeaway there is that a small increase in annualized returns can have a big impact on your total return for any particular stock. And he concludes the data, of course, shows the relevance of the adage that says it's all about time in the market, not timing the market. Now, to put these returns into perspective, I thought it was important to look at $100 invested since 1928, and Mr. Aswath Damodaran did that for us here. The two red bullet points you see there, that's Vulcan and Altria. That's how much you'd have if you invested $100 in those firms in 1926. So he simply looked at from 1928, 2-year difference. But the S&P 500, $100 invested since 1928 would produce $787,000. When we think about annualized return, we often use the number 9%. So in other studies and analysis of the data shows that the stock market generally has returned about 9% annualized per year. So again, you can increase that by just a little bit and see a lot more money as a result of being able to do that, of course, over time. Now, the question here, how many of these 30 high-performing stocks are we holding? And it's important to first characterize the stocks that are on our radar. So we run 2 internal portfolios, basically 2 strategies. Disruptive growth, that's around 460 stocks. And if you look at that spreadsheet, if you're a paying subscriber, you can download that spreadsheet. It's a wealth of data. Now, you'll see that most of those would be avoids, right? So we find lots of red flags when we're analyzing the most exciting stories out there. It's a given you have an exciting story, but when you start to try poking holes in that, it can get rather interesting. Dividend growth, we look at around 80 stocks. Dividend champions, we license data from NASDAQ to produce this universe. We're holding 30 of those in our dividend growth portfolio. Of the top 30 best performing stocks, we're holding 8 of them. Why is that? Well, our universe selection process is purely objective. So we say, give me a list of all companies out there that have not only paid but increased their dividend for 25 years in a row or more. That's our universe. And our own selection process really looks at industry diversification. It uses Q scores. We calculate based on the data we license, and it's largely objective, though there are some subjective decisions that take place. Now, dividend champions represent quality. So if you're trying to pick the top 30 performers over time from a universe of 29,000 stocks, there's a 99.99 chance you wouldn't be able to. You'd be holding 11 of the top 30 right now if you invested in our core dividend champion universe. Of course, as I said, 8 in our own portfolio. Around 14% of the stocks in our own Quantigent's dividend growth strategy are among the top 30 performing stocks ever. That's really interesting. So nearly 37% of the best performing stocks ever are dividend champions. What can we conclude from that? Dividend champions represent some of the highest quality companies out there. And when we look at this study further, and if you're a paying subscriber, just send us an email and we'll send you a copy of this study. I think we're going to review it pretty thoroughly today, but you still may find it to be of interest. This table here shows, for example, a breakdown of these stocks based on buckets in terms of the amount of return data available. So you see Panel A is all stocks, as I said, 29,000, right? Then you say, well, I want to see all stocks with return data at least 1 year. So at least you have 1 year of data, and that gives you 27,751. Then you say, well, show me ones with 1 to 5 years return data, and then you have a set of 10,000. So we're going to look at these buckets, but I wanted to point to what's highlighted in the middle there. The mean return for essentially all stocks with a year of data or more is 27,700 stocks, right? The mean return is rather high, 23,933%, right? The cumulative compound return, the average. But if you look at the median, so if you remove the outliers, essentially, then you would have lost money on average. That's remarkable, right? So you need to be very careful when you're deciding to pick stocks. You have much better odds of success if you just invest in ETFs. But when we look at these return data buckets, you see here that there's only 5,139 stocks with more than 20 years return data. But we can look at these buckets. So of the 10,000 stocks that have 1 to 5 years return data, which showed the best performance? And you can see down the list here, they say, I think this statement is rather true. Such dramatic returns as you're seeing here, they're sorted by annualized compound return. These have historically not been sustained over long intervals, of course, right? So the longer you go, the less the annualized return will be typically. And here I've just highlighted a firm that had 1 year of data, and therefore the annualized return is going to be about the same as the cumulative compound return, the total return, right? But then look at Network Solutions. I've highlighted that. They have, 2.7 years return data, and their annualized compound return of 277% grows very quickly when you start measuring it in more years than one, right? So as long-term investors, we don't really find this table to be very interesting. This next table I don't think is that interesting either. It's firms with 5 to 20 years return data, and they say here that none of these stocks are actively listed anymore because most were acquired, and that 8 of these high-performing stocks exited this database between 1997 and 1999. So that would have been the dot-com bubble, right? So rather interesting to see that. Again, this is sorted on annualized compound return. Then when we raise the bar to 20 years of data or more, so this is where we start to become interested because we measure our time frame in decades. So here you can see at the top of the list, there should be no surprise, they're NVIDIA. And there was a note in this report. It says, since the sample period ended December 2023, they didn't include NVIDIA's well-documented appreciation during the first half of 2024. So NVIDIA happens to be our largest tech position. It's been that way for a very long time. We invested in the firm, I think, 7 or 8 years ago. And what's notable here is this. When you have companies with very high annualized returns over a decent amount of time, at least 2 decades, right? What you see is that it's typically technology that's enabling them to grow so quickly, to truly disrupt, right? So look at the other names, Netflix, Amazon, Axon. That's an interesting one. So our subscribers, our paying subscribers, raised that and they voted on it and said we should cover it. So we'll be doing that, probably covered in a video. But then when you look down this list, you start to see some other things. Look, Home Depot. Wow, you wouldn't expect them to be disrupting. Perhaps their model of selling home improvement stuff to the Americans is pretty successful. So is selling pools, apparently. You see Pool Corp. So it isn't always tech firms, but this list is rather interesting because guess what? People talk about finding the next NVIDIA. What are they really saying? Well, they're saying, I want to find a stock that performs like NVIDIA. First of all, the next NVIDIA is NVIDIA. The same holds true for all next Tesla, next Microsoft, all those proposals. By next NVIDIA, they want something that performs as well as NVIDIA does. Well, this is what that company needs to do, right? This is how you get a stock to perform like NVIDIA's has. It has to be backed up by fundamentals. You cannot have inflated valuations for very long without those being corrected unless the fundamentals match. It's very important for people who see their stock running up as fast as possible because it's being pumped by all the FinTwats and apes. They're pumping stocks as they always do and acting irrationally. It's very important, too, to note that past performance is no guarantee of future results. So take this entire paper with a grain of salt, but I think it's rather interesting, and there's some lessons to be learned there, including some as follows. Hype needs to be justified by fundamentals, as I said. Real value creation, proper value creation, that takes place over decades, not just several years. Technology drives a lot of value in the medium term. And this raises the question, can a tech company ever really become a value stock? Well, one that did is IBM, but look at where they're sitting, right? They had some real problems. We did a piece on IBM recently. I think you'd find to be rather interesting. But perhaps the most interesting takeaway for me was that long-term value creation seems to overlap with dividend growth. And I don't think that's a coincidence because dividend champions exude quality. That's why we invest in them. So for any applicable income-producing asset, since you've seen the power of compounding over time, what they refer to as the snowball effect, make sure you turn on drips for your income-producing assets. And I'm going to go ahead and leave you with another video that I think you might find to be rather interesting. Make sure to give that a watch. Subscribe to our channel. Thanks so much for taking the time to watch this today.